Hey traders, this is Blake Morrow with Trader Summit, and it is Friday, and it's been twice in 1 week. I got to meet with this fine gentleman, so let's bring him in today. It's Friday, and we have Mr. Jim Welsh with Macro Tides. He's joining us today. How you doing, Jim?
Hey, it feels natural because it's Friday as
It
opposed to when we talked on Monday. I'm doing good. How you doing?
good, good. Yeah, it is a little weird when we talk midweek, but
Yeah.
anyway, it's
Oh
Friday,
yeah,
and
here we
I
are.
want to get your opinion here. Stocks have kind of recovered after having a rough week last
Yep.
week. They recovered this week. You look around at earnings and they're not bad. I mean,
Yeah.
I'm looking at earnings, and for the most part, I know expectations have dropped a little bit here and there, but we're beating expectations for the most part. How do you feel about earnings and where we're at as far as the economy goes? And I know you got charts to bring too.
Yeah,
So
yeah, 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 yeah. The economy's still doing okay, and we'll talk about the GDP report that came out yesterday, kind of understated the real strength. Earnings reports have been a little mixed, and companies that don't measure up get slammed. Some of the mega cap stocks have been uh, doing well because their earnings came in better than expected, except for Meta. But when we talked last week, Blake, I noted that the S&P and the overall market was really fairly oversold, and the expectation was that the S&P would rally to 5,100 to 5,130. And this morning, I think it got to 5,111. So, technically the market was poised for a rebound. The earnings came in good enough to, if you will, allow that rebound to progress. At the same time, the market is also dealing with the reality that we're not going to get all the cuts that Wall Street was projecting, expecting. And, the data that we've seen so far continues to kind of push out that first rate cut and obviously the number of rate cuts that might occur in this year.
right. I mean, it's hard for the Fed to cut rates when the hard data that we're seeing right now is the way it is. But you are going to point out that there are some things that are concerning, right?
Yeah, I mean, again, since late last year, when Wall Street was looking for six cuts, what we consistently talked about was the Fed's not cutting rates that aggressively with the unemployment rate near a 50-year low and the economy growing 3%. It just never added up. And now, in a sense, Wall Street is catching up to, oh, yeah, I guess that really doesn't make sense. And again, the whole narrative, as we've kind of again talked the last 2, 3 weeks, the idea was, okay, we're going to get all these rate cuts and the economy's still going to be okay. And then the rate cuts went away, and Wall Street's been hanging their hat on the idea that, hey, we don't have to worry about a recession, earnings are going to be good. And so to me, what that suggests, if at any point in time economic data comes along that undermines the idea that we don't have to worry about a recession, I think the market is even more vulnerable because that's kind of where they bet all their chips on. And, the narrative is no recession. And, one of the things we try to do in our videos is, you take the narrative, and then when it gets to be, if you will, the consensus, which is certainly the case at this point, one has to start looking at, well, what could happen that would surprise the consensus view. And that means looking out 3 to 6 months when you're talking economic data. And that's what we've tried to do by looking at labor market statistics, because the foundation of we don't have to worry about a recession is the idea that job growth is still good, unemployment's still really low, wages or growth are good. So if anything comes along that undermines that, I think that's problematic. And that's why, for me, looking at labor market indicators that are forward looking, not what's going to happen in next month's employment report, but 3 to 6 months, I think is key at this point in time. So,
Well, okay. Well, we are going to get it into some of your charts that you brought, and I want to start with the first one that you have here, and it's about GDP this week, right?
yep,
Okay,
yep,
let's get
yep.
to it.
And yeah, the headline number came in weaker than expected. The expectation was 2.2 or higher, came in at 1.6. And, there was a knee-jerk reaction. Oh my God, the economy is really slowing down. But if you looked underneath the surface, the reasons for 1.6 instead of a higher number were two things. Imports. So it's gross domestic product. So what the BEA is doing is what was actually made in the United States. So if we import something, they subtract that. So the point being for me is we really want to know what kind of demand there is. Is demand really weakening or is it steady? And so imports are a reflection of healthy demand. And they subtracted 0.9%. Inventories subtracted 0.3. So in other words, companies didn't build up inventories, which means at some point in time in the future, they likely would. So when you take those and you say, okay, well, let's add 1.2 to 1.6, and now you're closer to 2.8. Consumer spending was up 3.5%. And yet, looking at these two categories, imports and inventories, were one of the things that you and I discussed back in 2022 when everybody else was, oh my God, recession. We went through and looked at how the first quarter of GDP in the 2022, I think imports subtracted over like 2.2%. In the second quarter, Target, Walmart, everybody was purging inventories, and that subtracted, I think, 1.5 or 1.8%. So you have to look at these categories. Back then, everybody was in the recession camp, and I was like, no, we're not in a recession. There were other things that we talked about. So again, you have to look at not just the headline. You have to look at how did it get there. And that report, to me, overstated softening when the real growth was somewhere definitely above 2%.
All right, very good. So you got to dig a little bit deeper than just what's on the surface.
Always.
All right. Well,
especially the GDP reports, All right.
Yeah.
So one of the themes the last few weeks has been, hey, let's look out 3 to 6 months regarding the labor market, because as I said, the undermining of the foundation of, hey, we don't have to worry about a recession. Look at job growth is terrific. And I've been looking at some things that kind of say, hey, if you go out 3 to 6 months from now, we get towards the late third quarter and fourth quarter, there's indications that things are going to be softening. Because of the emphasis on GDP and the PCE report that came out today, I don't think the the S&P Global flash report on services. Again, services are 80% of GDP, goods are less than 15. And what we can see is the employment index within the S&P PMI services dropped to 47, below 48. Okay. Now, that looks a little unnatural to me. So I think that the extent of the decline probably overstates the real weakness, but we can't, I don't think, negate the direction, which is definitely down. The blue line is NFB hiring intentions. So last November, they were, I think, at 22 or 24% of small businesses, a plurality, were looking to hire. Now it's down to 11%. So these forward indicators are telling us, guess what? Job growth is going to slow as we go down the next 3 to 6 months. And, that I think more than any other piece of data will call into question, we don't have to worry about a recession. The next chart, Bank Credit Analyst does some absolutely phenomenal work. And I was very fortunate. Over 40 years ago, a man who kind of became my mentor started giving me the monthly Bank Credit Analyst report, Blake, and I just went nuts. It was so eye-opening and so forth, and it really kind of set me on the path that I've continued. So what their unemployment model is, well, let me back up. We get the national unemployment rate, which I think last month was 3.8 or 3.7. What BCA did is look at states and calculate what the unemployment rate is in those states, and then weight it by the population. So I think California's unemployment rate is at 5.3. New Jersey, New York are like 5.7, 4.7, 4.8. They got a lot of people. North Dakota's at like 2. So what they did by weighting that, and then their rule is this indicator moves up by 25 basis points or more, it generates a recession signal. Well, in March, it moved up by more than 25 basis points. The thing I will point out, if you look at the bottom panel, it kind of says, all right, the signal was December of 79. A recession began, what is that, February of 80? In other words, their signal was 3 to 6 months before then a recession began. So again, this just, in my mind, emphasizes as we go out into the later third quarter and the fourth quarter, there's more and more evidence suggesting there's going to be a notable slowing in job growth. And at some point in time, you are going to get probably a number below zero. Again, these are the things that I think are important to look at because, we don't have to worry about a recession. Just look at the labor market. Well, there's more and more signs that the labor market, which has been trending gradually to softening, that there's more signs that pace will accelerate before the end of this year.
Well, I'm hoping you're not going to be right, but it's some evidence that it's working towards that probability.
Well, again, our job isn't, we're ideally trying to see what's coming down the road before the majority of people. The biggest moves in markets happen when the primary narrative, whether it's, oh my God, the sky's falling, we're going into recession like 2022. Well, what happened? The market bottomed and we've seen a significant rally since then. Or, hey, we don't have to worry about a recession and we got a problem coming. And so to me, that's the whole point of this exercise is to identify narratives that are consensus and then see if there's anything coming along that are going to challenge that consensus. That's when you get the biggest move because everyone's positioned for a certain outcome. And when something else comes in, all those positions get unwound. And that typically leads to accelerated selling or accelerated buying.
So let's talk about TLT, which is the next chart that I have of yours.
Yep.
And so what are we looking at here? Because the bond market has been weak. I mean, we had some auctions, across the curve today or this week, some of the shorter end stuff. Not the best auctions I've seen. So it's maybe that's attributed to some of this weakness. What are you thinking here?
Yeah. Well, again, the expectation is that TLT is approaching a fairly significant trading low. That from the last October, there was a huge 5-wave rally up to the red A. That suggested that we were going to see treasury yields go up. And as the pattern has unfolded, it kind of says, okay, and last week, the expectation was we were going to get a bounce. We got a little bit of a bounce, and then we went and made a lower low. And so the minimum requirements to say, all right, we've completed an A, B, C decline for all of the big wave B have been met. There is a small RSI divergence, which is one of the things, when we talked on Monday, it's like, okay, I think we're going down again. And then we see an RSI divergence. Now, last October, it was a far larger and more significant divergence, but a divergence is a divergence. So now it comes down to, all right, some of the preconditions have been met. I think two other things, that downtrend line, the lower downtrend line, obviously TLT has to get above that. Ideally, the high on wave 4, I think, was 89.54. The 5 and 13 exponential moving average, the red has to cross above the green line, which is currently at 89.25. So now we've got the preconditions. Okay, we got our lower low. So the pattern could be complete. We got an RSI divergence, Blake. Now we need to see more positive momentum appear to, if you will, confirm what's already taken place. So my expectation is it's coming. We may see, as I said, the 786 is at 86.30. So until we get that positive momentum shift, we have to allow for a decline that takes TLT down closer to 86.30. Once this B wave bottom is in place, My expectation is TLT will rally by at least 18 points from whatever the low is. So a significant rally.
Yeah, I
Now,
was going to say that would be very significant. I mean, we're talking like, back up here, basically.
105 to 109,
Oh,
which has
oh,
been,
oh, you're talking about way up here. I'm sorry. I
well,
was
18 from 87 is
yeah, I guess
105.
that which would be right here. I was thinking that was a little bit different number. Okay. Hard to
Yeah.
read. I actually I need to put my other glasses on, not those glasses. All right.
Yeah.
Jim,
I mean,
oh,
again, the
go ahead.
question comes down to this is what the technical pattern is suggesting is possible. What could cause an 18-point rally in TLT? It's not the Fed raising rates. It's not the economy avoiding a meaningful slowdown. It's exactly the opposite. The economy slows more than expected, and eventually the Fed plays catch up. The one thing, I'm writing the May macro tides, and the point I would make is the inflation numbers that we've gotten kind of puts the Fed back on its heels, longer, all right? Which means if inflation kept trending down, they could have the freedom, if you will, to react quickly to signs of softening in the economy. With inflation being sticky, they're going to have more convincing signs of softening before they would act, which means that with the first pieces of data that show the economy slowing, I don't think the Fed is going to, we're cutting rates next month. And that, I think, is where the vulnerability for stocks is the greatest, is, wait a second, the economy's slowing more than we thought, and the Fed can't really move right away because inflation's sticky. If that happens, I think equities, get beat up.
Right. Well, speaking of equities getting beat up, here's the S&P.
Yeah.
I guess this is going to lean into what you were just saying.
Yeah. So, on Monday, as I said earlier, hey, really oversold, look for a rally up to 51 to 51.30. And we got to 51.11. A and C would be equal at 51.23. So we're in the same kind of place where, okay, the S&P has completed the minimum requirement where you got above 5,090 to complete an ABC. There may be a little bit more room to go. The assumption here, Blake, is that from the high in early April, we're in the process of doing 5 waves down, and that the S&P will trade below 49.54 at some point in time in coming weeks. And then we're going to have, I think, a bigger bounce. But right here, to me, the odds are, taking a short position, looking for a decline, using a 1% stop or so, I think makes sense, because we're talking about a decline that potentially could take the S&P down, 3% to 4%. So.
All right, sounds good. Well, I don't think you have to say any more than that on the S&P. But how do you feel about the dollar? Because the dollar, I was actually I've actually read a few people that are looking for an actual decline from here, where we are currently at today,
Yeah,
down into the 90s. So I know you've been echoing that sentiment, but the dollars, this looks like a consolidation right here. So what do you think, Jim?
I agree. I mean, basically, we've talked probably for 2-3 weeks now. Hey, if you do the wave numbers, in terms of lengths and all that happy stuff, the target was 106.62, 106.71. It got to 106.52. The pullback, to your point, looks like an ABC. It's very choppy. It looks like a consolidation. The bar for today took out yesterday's low and is higher than yesterday. So to me, that implies the dollar's going very near term, next handful of days. I think the dollar is going to push higher. Ultimately, I've said this many times, I think the dollar will trade below 100 sometime this year. Again, my take is the pattern in the dollar has been benefiting from, we're going from 6 cuts to maybe 1, and the economy holding up better than expected. And if the dollar is going below 100, that it would imply, I think, the economy's slowing. So I think just a little bit more strength, Blake, and then I think the dollar is going to roll over.
I'll take 110, then down. How about that? Can we do that?
That's possible. No, it's possible. I mean, if we keep, one can't eliminate that you
Yeah,
could take out 107.34 by a
sure.
little bit.
I
But
mean,
the bigger move that I
the,
think is coming, Blake,
yeah,
is the down arrow that you just wrote, you just put on there, you
right.
know?
Whether where we top out here in the very near term, whether it's here, or, up at these highs
Yeah,
or maybe slightly higher, somewhere here, or it could be straight down. But you're looking at, either or we're heading down by the
yeah.
end of the year.
Well, and again, the red and green lines are the 5 and 13 period exponential.
Sure.
So if we're going to top and roll over and then trend lower significantly, those will roll over. The 5 will cross below the 13, and that'll provide a decent entry point.
Well, Jim, I think then your analysis, and let me guess, gold has to be really constructive right now.
No,
Tell
no.
tell us how you feel about gold, though. I know a lot
Okay.
of people that are long gold. They want
Yep.
to, hear that it's still going higher. What are your thoughts?
Well, again, you had that 24-27 high, and like the dollar, the pullback so far looks like an ABC. And that leaves open the potential for one more push above 24-27 that will complete the rally that began back in February. So, that top would be wave 5. So and look at the RSI. If it gets above 24-27 or whatever the closing high was, there's a good chance the RSI is going to diverge negatively by a decent amount. So my only point is, hey, if you get that pop, lightening up into that pop, I think makes sense. Ultimately, I think gold will drop below the recent low. And as I know, 2260 is a 382 retracement. So I think after any near-term strength, we're going to see a period of weeks where gold works its way down, and then provide another buying opportunity. But we're not there.
All right, very good, Jim. I really appreciate your analysis, and I know everybody here does as well. And it's nice to have you 2 times in 1 week. I mean, that's
Overload, baby.
it's a little Jim Welsh overload, but we like it, and I know people even want more than that. So, what's the best way for traders to follow your work, Jim?
Macrotides.com. You can subscribe, get the weekly technical review. I give faithful listeners and viewers of the videos a nice discount, and send an email to Jim Welsh Macro if you want to see a recent publication.
Well, Jim, we do appreciate you and having you here at least once a week, if not twice sometimes. It's nice to have you here this week, and I'll look forward to catching up with you next week. Thanks for guiding all of us traders. And if you enjoy Jim's interviews every week, make sure you give him a thumbs up, subscribe to the channel down below, and also jump in the comments section and give Jim a piece of your mind if you don't agree with what he's saying, or maybe you have something to add to what he's saying. I'm sure he'd love to hear from you.
Yep. Thanks, Blake. Have a
Thanks,
great
Jim.
weekend.
Thanks, everyone. Talk to you next week. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.